about to hear my conversation with Dustin Reid, our Chief Fixed Income Strategist. We talk all about the recent central bank actions, what the latest inflation data has been, and what trades they currently have on in their portfolios. I hope you enjoy. This podcast is for informational purposes only. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Listeners should seek professional advice for their situation. Welcome to the Mackenzie Investments Podcast. My name is Matthew Schnurr, and I'm delighted to be back with your Chief Fixed Income Strategist, Dustin Reid. Dustin, welcome back.
Hey, great to be back on the program.
We've always timed these sort of post-BOC or post the Fed and the U.S. decision. And yesterday, the Fed came out and hiked 25 basis points. Love to get your reaction to, I think it was largely expected that that's what they were anticipating doing, but love to get your reaction on some of the comments that you're hearing or perspective on where you think they're going.
Yeah, absolutely. The Fed's always an interesting meeting, 8 meetings a year. This one was obviously the July meeting, which is not a forecast meeting for the Fed. The last meeting before this one in June was a forecast meeting, but indeed the Fed hiked by 25, as was very much expected by, I would say, almost everybody. I think the market was pricing about 23 or 24 basis points going into the meeting, so no massive surprise. There are a few interesting takeaways, I think, from the meeting that are important for investors and for markets. The formal statement at 2:00, which is the most formal document that the Fed releases, definitely came out on the hawkish side. I think overall the meeting was really, in many ways, about what was not said as opposed to what was said. And so by that I mean in the official document at 2 p.m. Eastern, the Fed did not change any language around its inflation expectations or outlook, and that was a bit of a surprise to some. I would include myself in that camp, particularly after the June CPI numbers that came in. I would say notably weaker than I think the market expected, and we continued to see that softening inflation trend. For the Fed to, in the formal document, not acknowledge that was interesting. So people had a very hawkish reaction coming out of the statement part, but half hour later when the press conference started and we kind of got through some of the Q&A, said a few things and didn't say a few things that were interesting. One of the things that he said was he had a bit of a gap between the tone coming out of the statement on the inflation that I was just mentioning, but in the press conference, he was a little bit more dovish on inflation and kind of went, I don't know if he went off script, but there was definitely a bit of a gap between the tone that I was picking up that he wanted to, I think, get across the table during the press conference versus the statement. So I thought that was interesting. What was also a really interesting takeaway from the press conference was the fact that, at least from what I saw, he never referred to or acknowledged the second 25 basis point hike that the median participant penciled in at the previous Fed meeting in June. Recall when they increased the 2023 dots by 50 basis points, which presumably meant 2 by 25 basis point hikes. And typically at these non-forecast meetings, like we just had this week in July, Powell will heavily lean on the previous meeting, which is a forecast meeting, and say, well, these are our forecasts. There's no reason to move away from that. He had ample opportunity, including the first question asked, and I would say at least one other question, if not two more, throughout the press conference, to lean on the median, the dots, or the median participant, suggesting that there should be another 25 basis points, and he opted not to do that. And I think the market, in real time yesterday, picked up on the fact that he didn't go there, so to speak, and didn't say anything. And you saw a bit of I don't want to call it Goldilocks, but a bit of a risk positive or positive for global risk sentiment type price action across asset classes, whether it's rates, credit, currencies, fixed income, equities, that sort of thing. So I thought that was quite interesting, and we're seeing a little bit of follow through on that as well today. So I think that's an interesting takeaway. We'll see how some of these Fed speakers, maybe this week, next week, follow through on that. But for Powell not to lean on that really does seem to suggest that the Fed is. I don't want to say they don't know what's next, because I think they have a decent idea of what's next, but they are somewhat unsure of the next small section of the cycle. I personally think that the next meeting in September, even though it's a forecast meeting, is not overly live. I don't think the Fed is seriously looking at hiking rates in September. I think that the October 31st, November 1st meeting is somewhat live. We'll have to see how the data comes in. And I think that, like many of the other central banks, the Fed is extremely data dependent, month to
Right.
month, meeting to meeting, and that's not really a cop out. I think it really is genuine that the Fed and other central banks are really unsure, because I think a lot of the models that the Fed and other central banks use haven't necessarily performed. I think people are, particularly on the labor market side, labor market in the U.S. and I would say here domestically in Canada, has hung in there a little bit more than I think most people would have expected, given the amount of rate hikes that we've had over the last year and a half. So I'm not totally giving up the ghost on another Fed hike, but we'll have to see how things go. With this hike by the Fed this week, the 25 basis points, the Fed moved the Fed funds rate to 5.25, 5.5, which is a view that I've had for a long time, really since late February, after the January PCE data printed in late February, and we moved from the 5.25 Fed funds range to 5.25, 5.5. So Fed's effectively there. At the time, we moved it to 5.25, 5.5 with an upside bias, and I guess I would still retain that upside bias here on the margin for now. But we haven't moved, or at least I haven't moved my own Fed funds forecast here after the Fed meeting this week. Not that I'm not expecting them to not go again, and it's not the best English, but not that the Fed's completely done. But the data is challenging, and I think, like I've said many times, there's at least two camps inside every central bank, if not three or more, and there's going to be people that are going to see the next iteration of the data with inflation slowing as, okay, well, our job is done and here we go, and we just need to let things settle, roll through the system. And there'll be other people, I think, if I'm correct, where inflation, even though it's slowing and stopping or leveling off, so to speak, at a higher level than target, and the hawks would point to that and say, well, more to go if we're going to meet our mandate. And there'll be people in the middle. And that doesn't even talk about the labor market, which, if the labor market doesn't necessarily fall off like it has in previous cycles, then the hawks in particular are going to say, look, there's a potential here for stronger employment to boomerang to higher wages, stronger wages, and inflation is going to remain higher, and risk, not only risk moving higher, but at a minimum stay higher for longer, and we need to do more. So I think that discussion hasn't necessarily completely abated yet, and there's more to go. But that's essentially my view, just from an economics perspective, anyway, on how the Fed came through this week.
Great. I want to pick up on your discussion on labor markets and sort of talk more broadly about inflation figures around the world. You referenced the relatively soft number in the U.S. Well, that was the case within both Europe and Canada as well. But sort of in a juxtaposition, you have a still very resilient labor market. I think many people, maybe not many people, but some people are perceiving this as maybe they're actually going to achieve sort of the Goldilocks scenario where they can bring down inflation and maintain employment. Love your thoughts on that, and maybe specific comments on Canada and Europe.
Yeah, for sure. So this Goldilocks era, in whether it's the economy or markets or both, is obviously something that central banks, people strive for. Sometimes it can be achieved, sometimes not, and of course, always when it's achieved, it never lasts forever. It looked challenging at the beginning of the year for the Fed to be able to engineer. I mean, some of it's luck, some of it's its own engineering, but engineering a soft landing, right? And then
Right.
that's kind of when you had this discussion of, well, maybe there's no landing. And
Right.
with the economy strong, we've had the U.S. Q2 GDP numbers print this morning, pretty decent. With final domestic demand and inventories aren't necessarily contributing a lot to the top line growth. GDP printed higher than expected. You've got core PCE as defined by the national accounts data slowing. So you got a bit of a Goldilocks scenario, happening there. I think a lot of these central banks are not sure, and that makes it challenging to call markets. And I think because central banks have the potential to kind of gear up and gear down at will. I think in the in Europe, where we've had an ECB meeting this morning, in fact, you've seen the ECB, in fact, move to even more of a data dependent mantra after essentially saying we need a reason not to hike. Now I think they're moving closer towards, maybe not quite there, to we need a reason to hike. And the bun fight over the September rate hike for the ECB, which has been a real point of contention, I think, for both the doves and the hawks on the ECB over the last couple of months, is now really going to come full force. And similarly here with the Bank of Canada too, right? We've had the bank essentially said we're going to take a pause in January. It did for the bulk of the first half of the year. Came back in June and surprised many, including myself, I would say, and hiked in June and then July. Not that I wasn't expecting them to come back. I was, but I was expecting July, September,
Right.
and they've done June, July, and we'll see if they come back for September. My inclination is that the bank is probably okay at 5%. Bank Canada is probably okay at 5%. So I think from a Fed perspective, from a Bank Canada perspective, from a European Central Bank ECB perspective, I mean, just from an accounting perspective, this is easy to say. We're closer to the end of the cycle. I mean, that's factual.
Sure.
There's nothing
Right.
earth-shattering about that. But I think kind of beyond the accounting side of it, I think we are closer to the end of the cycle, because I think you're seeing these banks in particular move to be very direct in terms of their messaging to markets and Main Street around, we are very data dependent. And if the data suggests that we need to go, we'll go. But we're not preconditioned to continuing this hiking cycle on an every meeting basis. I mean, obviously that was the case with the Bank of Canada having had a big pause for most of the first half of the year, right? And obviously the Fed had paused or skipped, I guess was the term of
Right.
the term of the month, in June. So we already knew that, but it looks like the ECB this morning is very much jumping on that same evolution of that global narrative. And so I think that's important, because we're all, there are other central banks to talk about too, but those three, which we spend a fair bit of time on, and I would add the Bank of Japan. Those are the four main markets that I mean, besides EM, that I spend a fair bit of time on within the G10 space. Japan's obviously on its own path, but those other three are very much aligned right now. I mean, clearly they're at different notional rates or nominal rates of policy, and doing different things on the quantitative easing or quantitative tightening side. But we're seeing some alignment there, and so I think that we're seeing, particularly in North America, we're seeing the inflation numbers slow, right, to around 3%. On the headline, give or take. The European side, the headlines are slowing as well. But for the most recent for the most recent European data, and we'll get more probably while this podcast is being listened to over the next week or so. But the most recent data actually has core CPI in Europe ticking higher on the annual basis. It ticked higher for the most recent print from 5.3 to 5.5. And that clearly is going to keep the ECB ready to go if that,
Right.
if that continues to become an issue. In North America, I think that there's a decent probability here. It might be a bit early, but that we've put in the trough, put in the low for the next few months on headline CPI in the US when looking at it on an annual basis.
Right.
So I think we could actually see the year-over-year CPI number in the US actually move a little bit higher in like for July when we get that print in August, and then also for August in September, and maybe even for September when that prints in October. And when you look at the CPI fixing market, which is a very, very niche type of market that trades around CPI futures, so to speak, it's also expecting that. Part of that, I think, is the base effect coming out. So base effect is basically last year's number coming out. The way the accounting works, it kind of suggests that there's a little bit room on the upside for the annual number to move higher. But I'm also watching oil and energy prices broadly and food prices. We're seeing energy prices move higher, particularly oil, Brent oil, kind of the global benchmark. It's well off its lows, and I'm seeing and hearing that there's a little bit more appetite to see, based on inventories and based on some other things within the macro oil market, that oil could continue to move higher. And I think this move from Russia to exit this Black Sea agreement around exporting various agricultural products is potentially an issue on the food side. And then there's also a headline or a story or an idea running around that rice getting exported out of India is being somewhat constrained for domestic consumption, and you've seen some types of rice, not all types of rice, but some types of rice spike by 2 or 3x, and some of that rice is kind of a mainstay in North American diet, Asian diets. So I look at those things and I say, okay, where's the balance of risk here? And inflation on a headline basis could potentially, as we would say, curl up a little bit here. I don't think it's massive, but it takes maybe away from the narrative that we're going to see inflation continue to fall away. So I think this is why the market has many different views. I think this is why central banks are very uncommitted at this point and want to see literally month by month by month how the inflation narrative evolves, and obviously how their own domestic labor market narratives evolve. I think it's tricky. I'm not expecting cuts anytime soon by any stretch.
Sure.
And I think we are in a general period now after clearly moving from 6, 7, 8% down to kind of this 2.5, 3, 4, depending on what measure you're looking at and what geography you're looking at, neighborhood. But we could see a little bit of a blip here. So I want investors to take away that I don't think that the inflation picture is totally linear lower here. We could see a little bit of a reprieve. Doesn't mean that we're in trouble and inflation is going to rip back higher. It's just could be a little bit. Think of it as a bit of a speed bump in the overall directionality of inflation grinding lower. So we'll see how that obviously all evolves the next little bit. I think it makes a very, very interesting macro trading environment here for the next few quarters for sure.
Maybe just to follow up on that, maybe a two-part question, but one, central bankers, the description on inflation and what some of the core drivers of it may be, that being base effects and some of the commodity things that you touched on. Are central bankers likely to react to that, or will they look through it? And then a sort of second part to that is, as the bankers become more data dependent, does that increase the range of outcomes for markets just because it's a little bit more challenging to predict central bank reaction?
Both good questions. So on the first part, I think at a minimum, it probably underscores the higher for longer. I mean, that's kind of the safe answer, but I think that that's true. And it's a narrative and a thread that we've had for a long time, right? Getting from 8 to 5 is one thing. Getting from 5 to 2 is going to be quite another. And it kind of necessitates the higher for longer narrative. So I think that is more the most likely scenario. I don't think it's big enough to re-accelerate the hiking cycle. Let's put it that way.
Got it.
But to your second question, I agree. I think when at these inflection points in the cycle, when you have central banks kind of going off script in a way, right? Central banks are really supposed to be looking, I would say, 18 to 24 months out and trying to conduct policy now to make sure that policy is going to be appropriate in in 18 to 24 months time. When the central banks are so short-term focused, you have a recipe for higher volatility in markets and different messaging coming out of even the same central bank. I think we've seen that a bit over the last couple of months. I mean, clearly the Fed has been part of that, and I would say the ECB has also been a part of that. I mean, the Doves and the Hawks have been at each other via the press in Europe for the last couple of months. Very significantly. I mean, clearly, you would even see some press within the hours after an ECB meeting, basically refuting some of the comments that President Lagarde, made, or maybe opted not to make. So you're seeing that consternation, I think, and so I think that makes it challenging for markets, and that's why I mean, it is a bit of a default line to some, but I genuinely believe it when I say these are really, really interesting markets to trade because, tactically, if you have a strong view and you think you have an edge and you think things are going a certain way, you can see moments in time where the market trades away from that, and it's an opportunity to get in at a better level, or average down, so to speak, or average up, depending which way you're going, on various securities or ideas. So I think it's a really interesting market to trade, and this is where I think active macro management, particularly within the fixed income space, and we obviously do a decent amount of FX as well, is really, really interesting. And so even though it's challenging, I look at it as a really good opportunity set, because when things are somewhat on autopilot, there's a higher probability that things are more in the price and there's less opportunity for alpha. Here, I think there's more interesting opportunities for alpha as we kind of stick handle it. I mean, obviously you have to be, more right than wrong, which we obviously try to do, but the opportunities, I think, are plentiful here for the second half of the year.
Seems like a great segue to talk into what you're actually doing in the various portfolios. What trades do you have on, given your macro view?
Yeah, for sure. So there's lots to play for, and there's lots that we have on, and lots that we're looking at. Some of the things that we have on, without getting too much into it, just because just the timing of the podcast, there is a Bank of Japan meeting coming up here in the next 24 hours or so, and we continue to have this very large short JGB futures position on, not only within our unconstrained and global portfolios, but also in our core plus portfolio. So we're short the futures. So prices lower, yields higher, and we'll see what we get from the BOJ, and that continues to be a core holding for us. Whether something happens in July or something happens later, it continues to be a core holding for us. But I won't comment too much on it now, because I think by the time this gets out, the BOJ will have made its announcement. Right. A few other things that we like that are core holdings. We've had particularly in global and unconstrained, but to an extent in some of the core funds as well. We've had and I wouldn't even say an overweight. I would say a significant overweight position in real yield fixed income, in particular U.S. TIPS, or Treasury inflation protected securities, and that position's done relatively well for us. We liked buying that, particularly at the long end of the curve, mostly in kind of the 30-year space. We liked locking in those yields. They've traded in a little bit with inflation coming lower, but a few months ago, when you could get 5 or 6% inflation with 150 basis points in addition to that, I mean, you're looking at a AAA security that was yielding 6.5%, which is pretty pretty good, right?
Yeah, sure.
And liquidity in TIPS, at least for our size, is good enough that we could get in and get out relatively comfortably. So liquidity wasn't a big deal for us. For some shops that are massive, liquidity can be an issue in TIPS, but for us it wasn't. So we really liked it as a core holding, and I think for the balance of the last 2, 3, maybe even 4 months, I mean, my comment to the team generally, not always, but generally, was if we want to add duration in the G10 space, I generally like adding real duration as opposed to nominal duration. Now, that gap has probably narrowed a little bit here in the last few weeks or months, although I'd still probably lean, generally speaking, towards real yield over nominal yields. But we've been, where we get a lot of our duration, particularly in unconstrained and global, is on the real yield side, and particularly U.S. tips. But we also hold the fabulously titled real return bonds, which is literally what they're called for Canada.
Right.
And then globally, people would call the sector linkers, linked to inflation. And we have, we're in and out of the European side as well. But that tips trade or real return bond trade, so to speak, for our linkers trade has been a core tenet for us, and has been very, very beneficial to, I think, our some of our outperformance over the last quarter or two, which is great. Another trade that we've had on in size in the last 3 months across all our portfolios has been emerging market local currency debt. So we're buying local bonds, local emerging market bonds, and keeping it in the issuer, the country issuer, and generally keeping the currency open, not all the time, but often. We've been predisposed to LATAM, and within LATAM, we've been predisposed to Brazil and Mex. Part of that 2-3 months ago was the idea that real yields in Brazil and Mex were looking very, very attractive, picking up maybe 700 basis points in Brazil. And we were relatively comfortable with the idiosyncratic risks around Brazil. And I would say Mexico, the number 2 on the list overall, not only in LATAM, but overall globally, and maybe slightly lower, maybe in the 5.5 or 6% neighborhood for Brazil, for Mexico in terms of real yield capture. And again, comfortable with kind of the idiosyncratic risk that may or may not be associated with Mex. And we thought that they were, particularly the EM central banks got into the cycle early in terms of hiking, and we thought they would get out of the cycle relatively early in terms of easing. And we haven't necessarily seen that yet, but we're close. And we think the LATAM banks of kind of the major 3 regions between emerging Europe, Africa, and then Asia, and then LATAM. We thought LATAM would exit first, and we could see the Brazil central bank cut as soon as August next month, which I think would help solidify our position. So we've had significant positions on there, although we've shaved a little bit off of some of it from where we were max maybe 4 weeks ago, but still I would say overweight to somewhat overweight there. And that's also been a pretty good performer from that perspective. So those 3 positions, Japan, linkers, particularly US tips, and EM, particularly LATAM, EM local currency bonds have been I've been spending a fair bit of time on all of that. There's other little things in terms of kind of being in and out of the front end of the nominal U.S. Treasury curve. Ditto for the front end of the European curve, particularly the German benchmark, and a number of other kind of tactical things. We've been short UK gilts, looking for maybe a bit of an issue there in terms of what we had last year as a small position. But those ones are relatively small in terms of overall duration contributions to the portfolio compared to the first 3 that I mentioned, which are very, very significant in terms of tactical alpha. So those would be kind of the ones that are still interesting, and I'm sure there'll be many, many more to play for here. We're obviously always looking to see, at this point of the cycle, is it time to get into the ever famous structural steepener,
Right.
steepener curve, whether that's Canada or the U.S. or somewhat else. And I think we are getting closer. And again, kind of from an accounting perspective, time allows you to say that. Obviously, you're getting closer with time. I mean, all cycles come to an end. But with these labor markets continuing to be hanging in there, I saw the claims number this morning out of the U.S. Again printing a new low. So lower claims is a stronger labor market. It challenges the idea that the steepener is right around the corner. So I mean that's a trade a lot of people want to have on, real money like us. The macro funds globally, the multi-strat funds globally have been itching to get it on. Many have had it on and been burned. I think it will be time at some point, and that's definitely one we're going to look to get on when the time is right. But we're not quite there yet. But we'll see how the next 1 or 2 months develop going into September with the data evolution and how these central banks want to handle their September meetings.
Well, Dustin, let's call it there. Really great insight. Thanks so much for spending the time, and I look forward to our next conversation.
That sounds great. Thanks very much.
content of this podcast, including facts, views, opinions, and recommendations, is not to be used or construed as investment advice and is not an offer or an invitation to buy or sell any security. The content of this podcast should not be relied upon for any purposes, and Mackenzie Financial Corporation is not responsible for any reliance upon it. This podcast includes forward-looking information that reflects our current expectations or forecasts of future events. Forward-looking information is subject to risks, uncertainties, and assumptions that could cause actual results to differ materially from those expressed herein. Our views are subject to change based on market conditions. Commissions, trailing commissions, management fees, and expenses may be associated with mutual fund investments. Please read the fund facts and prospectus before investing. The indicated rates of returns are historical annual compounded total returns, including changes to unit values and reinvestment of all dividends or distributions, and does not take into account sales, redemptions, distribution, or optional charges or income taxes payable by any security holder that would have reduced returns.